Welcome back to the deep dive. Today, we are opening a file that I have to say is going to surprise a lot of people. We're calling this deep dive Griffonomics.
Griffonomics. I like it.
It is Saturday, February 7th, 2026, and we are looking at a company that has been on a wilder ride than anyone actually using their equipment. Peloton.
It has been a total roller coaster. I mean, if you just go back 5 or 6 years, they were the absolute pandemic darling.
Yeah.
The unicorn that could do no wrong.
Right, and then the crash.
Then the crash. But what we're seeing in the documents released just this week, the Q2 2026 earnings, it's something totally different. This isn't a growth story anymore. It's a survival story that's morphing into something else entirely.
And that's exactly the mission for today. We have the earnings transcripts, we've got the strategy roadmaps, all the analyst notes from the last few days, and we really need to answer one core question.
Yeah.
Can a company that was built on this growth at all costs mindset actually survive by shrinking? Because looking at these numbers, they are definitely shrinking.
They are. But the argument they're making, in these investor calls is that they are shrinking into a diamond. They call the strategy fit for growth.
Fit for growth?
Yeah, but a more accurate description might be fit for profit. It's a fundamental pivot.
So let's start there with identity. Because for years, if you said Peloton to me or, anyone listening, the image that comes to mind is that bike.
The bike with the screen.
Exactly. A stationary bike with a screen. Looking at their 2026 strategy, is that even accurate anymore?
Not really, no.
Yeah.
If you look at this connected wellness pivot they outline in the filings, the bike is just a hook. It's the entry point.
A hook for what?
They're explicitly trying to move from being a hardware company to being a wellness ecosystem.
Mm-hmm.
They want a slice of that $7 trillion global wellness economy. And you don't get that just by selling spin classes.
Okay, so what does that look like in practice? I saw they refreshed the hardware late last year, the cross-training series. To me, it just looked like they tweaked the screens a bit.
It looks like a tweak on the surface, but that refresh is the physical proof of the strategic pivot. Think about the one specific change they made to the screens.
They all swivel now.
Right.
Even the basic models.
Correct. And that sounds like such a small feature. Oh, great, I can turn the TV. But strategically, it's a massive admission.
How so?
By making the swivel screen standard across the board, they are basically admitting that the most important workout might not happen on the bike anymore. They want you flipping that screen around to do yoga, Pilates, and especially strength training.
Because you don't need to buy a $2,000 bike to do push-ups.
You don't. But they need you to use their screen to do them. In their own words, strength is now their #1 modality. They are trying to own your floor time, not just your seat time.
And they're expanding the content, too. I saw the breathwork acquisition.
Right, for mental wellness. So they have cardio, strength, mental health. It's a total wellness play. They're trying to make that subscription indispensable, whether you even touch the bike that week or not.
That makes sense in theory. But, wellness is a buzzword every company's throwing around. Let's get into the reality of the business. The Q2 fiscal year 2026 numbers just dropped a few days ago. And honestly, they look weird.
Weird is a good word for it. It's a total paradox.
It's like two different companies reported at the same time.
There really is. I mean, if you just read the headlines, it looks bad. Revenue was $656.5 million. They missed the analyst estimates by almost $20 million. Sales are down 2.6% year over year.
So bottom line, people are not buying the bikes.
The hardware sales are eroding, yes. The demand just isn't what it was during the boom. But then you look at the bottom line.
Okay.
Adjusted EBITDA, which is basically their operating cash flow, it was $81.4 million. They beat their own guidance by $6 million.
Wait, walk me through that. How do you miss your sales target by 20 million but beat your profit target by 6? That math doesn't seem to add up.
That is Griffonomics in action. They have managed to decouple their profit from their growth. For years, the math was simple. Sell more bikes to make more money.
And now?
Now, the math is cut costs so aggressively that we make money even when we sell fewer bikes.
So they're literally saving their way to profitability.
Precisely. They are stripping this company down to the studs. They cut headcount by another 11% just last month, in January. They have this target of $100 million in run rate cost savings. It's got to be brutal for the culture, I'm sure, but financially.
It's working.
It's working. The gross margin on the subscription side is over 72%.
72%? That's not a hardware margin. That's a pure software margin.
That is pure software company territory, and that is the absolute key. The subscription revenue is like the Wall Street part of the business that's subsidizing the manufacturing side. But to keep that margin, you need people to stay.
And that's the catch, isn't it? Because I remember they raised prices back in October 2025. Usually when you hike prices on a luxury product, especially in a shaky economy, people cancel.
Oh yeah, Wall Street was terrified of a mass exodus. But look at the churn rate in the report, 1.9%.
Wow. That is shockingly low.
It's incredibly sticky. Even with a price hike, people are just not leaving. And that stickiness is why they can afford to sell fewer bikes. They just need to keep the current members paying that monthly fee.
But hold on. You can't just cut your way to prosperity forever. I mean, eventually you can't fire anyone else. You can't close any more stores. You need something new to actually grow.
Yeah.
And reading through their product roadmap, it looks like they are betting the farm on AI.
Peloton IQ.
It sounds like such a buzzword, I know. Every company has an IQ product now.
It really does. It sounds like something a marketing team just dreamt up in an afternoon.
I was skeptical too, but the implementation is actually hardware dependent, which is what makes it interesting. Remember that hardware refresh we talked about?
The Plus line?
Right, the Bike Plus and Tread Plus Float. They now have a movement tracking camera built right in. Peloton IQ uses computer vision to watch you work out.
So it's judging my squat form.
Oh.
It is, yeah. It's counting your reps, it's correcting your form in real time, and it's suggesting what weights you should use. It's an AI personal trainer.
Okay, I can see the appeal for the user. I mean, it answers that question, am I even doing this right? But why is this so critical for the business strategy? Is it just a feature to sell more of the expensive Plus bikes?
It helps sell bikes, sure. But think bigger. Think about switching costs.
Break that down for me.
Okay, so if you have a dumb treadmill, or even a basic Peloton without the camera, you can cancel your subscription and just run. You don't really lose much.
Right.
But if your Peloton knows your entire rep history, tracks your strength progress, knows your max bench press, and corrects your posture, you lose all of that data if you leave.
It creates a digital moat around the subscriber.
Exactly. It locks you in. If the machine knows you better than a personal trainer does, you're probably not going to cancel just to save, what, $15 a month?
That's actually pretty clever. It justifies the premium price. Now, there's another growth engine here that I think gets overlooked because it's not as sexy as AI,
The commercial side.
the B2B play. Peloton Pro.
This is a huge piece of the puzzle. We're talking hotels, corporate gyms, universities. This is where their acquisition of Precor is finally paying off. They call it Precor Brawn plus Peloton Brains.
Meaning Precor builds the heavy-duty gym equipment, and Peloton just slaps the screen on it.
That's basically it. See, Precor is already in, what, 60 countries? They have the distribution networks that Peloton on its own never had. They know the purchasing managers at Marriott, at Hilton. So Peloton is just piggybacking on that existing infrastructure to get their software into those spaces.
And is it actually moving the needle?
It is. The commercial segment grew 10% this quarter. It's actually outperforming the residential side by a lot. And they just launched the Tread Plus Pro, which is their first commercial-grade treadmill.
It makes sense. It's a giant billboard for the brand. You try it at a hotel, you like the interface, and hey, maybe you buy one for your home.
For sure.
Speaking of buying for home, the way they sell these things has changed completely too. I haven't seen a Peloton showroom in a mall in ages. They used to be everywhere.
Those are mostly gone. That was the growth at all costs era, these massive, expensive temples to the brand in high-rent districts. They're closing those legacy showrooms aggressively.
And replacing them with what?
They're opening what they call micro-stores.
So just smaller footprints.
Tiny footprints, much lower rent. But here's the stat from the report that matters. These micro-stores are generating 8 times the sales per square foot compared to the old fancy showrooms.
8 times? That's not a small improvement.
It's massive. It proves they don't need a luxury retail experience to sell the bike. They just need a point of presence. It's all part of that same efficiency drive. They're getting so much smarter about how they spend every single dollar.
Okay, so they're efficient, they have a B2B strategy, they have this AI moat. But let's look at the bank account. Because a couple of years ago, the headlines were all bankruptcy watch, Peloton is running out of cash. Is that still on the table at all?
I think we can officially retire the bankruptcy watch. They have built what I would call a cash fortress.
A fortress. That seems optimistic for a company whose sales are shrinking.
Look at the balance sheet. They are sitting on $1.18 billion in unrestricted cash. And they've slashed their net debt by more than half down to just $319 million. In fact, they have a $200 million debt payment due this month.
Right now, February 2026.
And they're just writing a check for it. from cash on hand.
No refinancing, no begging the banks for an extension.
No panic, no refinancing, just paying it off. They expect to generate at least $275 million in free cash flow this year. They have become a cash machine. I mean, a smaller machine than they promised everyone in 2020, sure, but a profitable one.
Then why is the stock at an all-time low? If they are printing cash and the bankruptcy risk is gone, why does the market seem to hate it?
It's two things, really. One, revenue is still shrinking, and investors hate shrinking revenue. It scares them. They worry it's a trend that'll go to zero. And two, uncertainty. The CFO, Liz Coddington, just announced she's leaving.
Ah, the classic signal.
The market never likes it when the person counting the money walks out the door right after an earnings report. It just makes people nervous.
So that brings us to the verdict. We have a profitable company, tons of cash, incredibly loyal customers, and a rock-bottom stock price. What's the play here? How should we view this Griffonomics experiment?
It's what Warren Buffett might call a cigar butt investment.
A cigar butt. That sounds pretty unappealing.
It's not glamorous at all. It's the idea of finding a discarded cigar on the street. It's dirty, it's beaten down, nobody else wants it. But it has one really good puff left in it.
And the puff is the cash flow.
Puff is the cash flow, exactly. Peloton is trading at a super low multiple, about 5.2 times EV to EBITDA. That is incredibly cheap for a technology company. The bet is that the market is so obsessed with the shrinking sales that they're completely ignoring the massive pile of cash.
So the bear case is they shrink until they disappear. The bull case is that they've stabilized as a niche, high-profit wellness company.
Right. Their motto for this outlook was literally risk-defined, portfolio protected.
Sounds like a company playing defense, not offense.
Defense keeps you alive.
Yeah.
They've stopped the bleeding. Now they just have to prove they can actually exist and thrive at this new, smaller size.
So here's my final thought for you to chew on. We have a company with a pristine balance sheet, over $1 billion in cash, and a stock price that makes it incredibly cheap to buy. The CFO is leaving. The company is leaner and more efficient than it has ever been.
Right.
Is Peloton actually planning for a long-term future as a standalone business? Or have they just dressed the bride for a wedding?
That is the multi-billion-dollar question, isn't it? A turnkey wellness division with zero debt. That looks very, very appetizing to a big tech giant who wants to get into health and data.
Something to think about.
Yeah.
That's it for this deep dive into Griffonomics. Thanks for joining us.
Always a pleasure.